everyone. Welcome to the Getting Sharpe podcast presented by Omega Point. I'm Omer Cedar, CEO and co-founder of Omega Point, and we've created this podcast to help our investor community understand some of the more relevant topics impacting institutional investors in the current market environment. Today, I'm pleased to be joined by Cameron Hight, founder and CEO of Alpha Theory. And Cameron and I are going to explore really the intersection of fundamental and quantitative portfolio optimization. Many investors, and in our joint community really grapple with the challenge of, hey, how do I generate higher, either Sharpe or a portfolio that's better aligned with my fundamental views, but is much more risk aware as well. There's also allocators and LPs out there today asking for all sorts of new products, right? Market neutral strategies and other things. So there's a lot of interesting things to explore here with Cameron that I'm super excited about, including some of the integrations that we're working on together between Omega Point and Alpha Theory. So with that said, it is my pleasure again to introduce Cameron Hight from Alpha Theory. Cameron, thanks so much for joining us today.
Yeah, absolutely. It's great to be here.
Wonderful. We've been working together for a number of years, and there's been a nice evolution of the industry and what investors really care about. And I really wanted to kind of start with tackling problems, right? I think our audience is always interested in what types of problems are we solving that investors care about today. So wanted to start with that and kind of give you the floor to talk about some of the problems that, certainly at Alpha Theory, you guys are tackling.
Yeah, so my background is I was a fundamental investor for 10 years and before starting Alpha Theory. And, the problem that we're trying to solve is that fundamental investors in general are very good at stock selection, finding companies, researching them. Where they make most of their mistakes is how they take that good fundamental research and turn it into a portfolio. And what are you doing when you turn it into a portfolio? You have to come up with position sizes. And the way that people come up with position sizes in fundamental land is it's educated guesses from a portfolio manager. And that leaves a lot to be desired. These are incredibly intelligent people, but still leave a lot to be desired. And it's not because they don't know what matters in sizing positions. They actually understand all of the things that should influence how they should size a position. They're just not good at putting it all together into a specific position size and then monitoring that position size over time to make sure that it's in lockstep with what their fundamentals are saying. And so that's where Alpha Theory fits in. At my old shop, I helped us create a more disciplined process to take all of that amazing logic that was in my portfolio manager's head and put it into a system so that we could see where there were deviations between what we were doing with our portfolio and what we were doing with our research. And we've been doing it for almost 20 years now, across hundreds of funds and thousands of analysts. There's 1 million price target forecasts that have been put into our system over the years. And what we've learned is that fundamental investors could be substantially better off by about 4% per year if they just created a more disciplined process for how they size positions. And so that being said, in this new paradigm where factors have driven a lot of the performance that we see in the market on a day-to-day basis, LPs are demanding that our managers understand their risk better, and our managers want to understand their risk better. And so I was introduced to Omer years ago, and he has taught me so much about risk for fundamentalists. I was a novice, or worse, when I first met Omer, but he has brought me up the learning curve, and I now fully understand why it's so important for fundamental investors. And so I'm really excited about the partnership that we have and what we can do, bringing together the fundamental optimizer that is Alpha Theory and the risk optimizer that is Omega Point to be a unified optimizer for a fundamental investor.
No, appreciate it, Cam, and it's great background. And I really wanted to then use this opportunity to dig into this idea of merging fundamental optimization and risk optimization, right? And we obviously came up with a year ago with some, a case study that kind of helped crystallize some of that, right? We called it intentional alpha. But really, I think from a perspective of maybe someone on the, that hasn't seen that case study or hasn't been as introduced to the idea of joining these kind of two forms of optimization into creating something kind of very intuitive. Can you describe it in your own words? What does it mean to merge fundamental and risk optimization, and what is the kind of ultimate output that the investor gets?
Yeah, so the way that we think of fundamental optimization, it is building a portfolio from the bottoms up. It is stock by stock. It is a stock has to pass a lot of risk gates to get to a full position. Let's say a fund takes a 10% maximum position size. It has to have a certain level of return. It can't have over X downside risk. We have to have done this much work. The management team quality and the balance sheet quality and my conviction level, all of these things have to score out to a certain level. And that's what deserves to be a 10% position. But throughout that, I really haven't thought a lot about what are the other positions in the portfolio. They're interrelated. We all know that. And their correlations matter. And I also haven't thought about the risk contribution that this asset adds to my portfolio. Of course, I'm thinking about it a little bit, but it's a complex equation that's really just too much for the human brain to be able to conceptualize. So I'm taking this fundamental research, and now I want to think about, if I add this position to my portfolio at the position size that my fundamental research suggests, how does that change the complexion of my portfolio? How does it change my systematic risk? How does it change my overall volatility or potential drawdown? All of these things, if I'm benchmark sensitive, how much does it change my tracking error? All of these kinds of things that are really important, but they don't come out of your fundamental research. And so what we want to do is take this fundamentally optimized portfolio in alpha theory and feed it directly into Omega Point, so that Omega Point can then allow the manager to say, what's important to me? I don't want to have any factor exposures above 10% plus or minus, and I don't want to have volatility over X, and I want to have my alpha above 70%, or whatever these kinds of things, these constraints this portfolio is going to need to have. Take the fundamentally optimized portfolio. Now Omega Point can give them that fully optimized portfolio. It thinks fundamentals first, but also within my set of risk constraints. And so that's what you ultimately get. You get portfolios that are maximizing the expected return from your research, while also giving you the risk budget that you're comfortable with. And we've seen it in, when we've actually applied this, we've actually put portfolios through this, we see an improvement in return. Most important, who cares if we don't get more return? Vol reduction, or at least somewhat flat, and dramatic pickups in Sharpe, and all of the incremental return that's coming out of these portfolios isn't all idio, it's all alpha. So it's really exciting what the combination of these two things, alpha theory and Omega Point, can do for a fundamental investor.
It's actually, I wanted to kind of dive into a point that you use when you're saying, the return is mostly, or idio, right? And, again, for the benefit of our audience, and some people, spend a lot of their time, working on making sure they have IDO, and some people aren't as familiar with idio, right?
These are the things you talk about.
I always love how I know you can talk about it in a very, very kind of inclusive manner, right? For everyone out there. Walk us through how you see, what is idio, right? And what is the alpha portion that you're talking about that kind of gets crystallized in this sum?
Yeah. I mean, I like, in its most simplest terms, we could go into the mathier ways of explaining it, but the way that I like to think of it is, it's the returns that are generated from the stock-specific theses, or the ideas that you have about a specific stock and how they play out in price movement, that have nothing to do with the market movement or its value orientation or its growth orientation or its volatility. It's stripping out, and it's just isolating those things that are stock-specific. Here's the thing. As fundamental investors, that's what you're investigating. That is what you're investigating, and that's what you want to have expressed in the return of the stock. And so removing those things that you weren't researching and weren't betting on is actually a good thing for your portfolio, because you're isolating the things that you're actually researching. And so when we talk about alpha, or we talk about idio, it is just trying to isolate those things that fundamental investors are good at researching. And so the return stream, it looks like what you would expect it to. I mean, if I get one of the most common things when I sit across the table from a portfolio manager in the last few years, it's just like the stocks don't move the way I expect them to move anymore. And, a big part of that is because there's all of these other moving pieces beyond the stock specific that is moving each individual security. And so when you isolate the portfolio to a lot of stock specific risk, you end up seeing a return stream that makes a lot more sense to you. Your portfolio starts to make a lot more sense to you.
Yeah. No, that's phenomenal explanation. And I think that, intuitively, right? I mean, you talk to PMs and they say, generally speaking, I find that returns come around events like earnings or around periods of times. I mean, that's actually when the stock is behaving in its most idiosyncratic, right? A period, and in other times, right, it could be moving because there's something in the political landscape, right? There's obviously macro political, okay, geopolitical is one thing. There's obviously maybe news about the sector, and there's maybe just in general flows that are coming from passives, right, that are doing other things, and so the stock just gets bumped around, right? And it's frustrating if it's not moving in the direction that you expect the fundamentals to be, and especially if you've got high conviction on it. So as you said, I think that the isolation of that strong period or the stocks that are behaving more like the fundamental views crystallize that. And also, I think as we found, right, that you get a higher return on that unit of risk. So when you put $1 of risk capital towards your stocks and you isolate them into that, you usually get, again, it's not across the board, but in general, you get probably 1 to 1.5 times dollars back on that risk capital from the specific or this idiosyncratic that you're talking about. And when it comes to the correlated part of the risk, sometimes it's zero, right? Or even negative, right? So you get a lot of reduction from the factor component of that. And that's why people say, get rid of that, right? It's not actually paying off. You're putting all this risk capital, you're not getting paid for it. Do you really want to put
not getting paid for it? And you're not getting paid for it, but also LPs don't want to pay you for it. That's not the piece of your return stream that's really valuable to them. So if you could isolate the thing that is the most valuable to them, and if you ask any smart LP, they're going to tell you they want to pay for your alpha. Because guess what? Alphas, this is one of the other things that Omer's taught me, alphas aren't correlated with each other in general. And so what you can get is a lot of non-correlated return streams when you buy a lot of these managers that have isolated their alpha, and you can put them together as an LP. So if we're trying to skate to where the puck is, LPs are going to continually ask for more and more of your return stream to be alpha generated. So being smart on how to you're still a bottoms-up investor. So you're still going to be doing things the way you've done them in the past. But then you need to create this portfolio. So still you do your research the same way, but you need to create this portfolio that is giving the LP what they are looking for from you so that they can take your return stream and combine it with all of the other managers they're investing in and their return streams to give the LP truly what they're looking.
No, well said. And it's actually a great kind of follow-up question around. I'm sure the PM, whoever's listening to it, say, okay, sounds great. I get what you're trying to achieve, but sounds very theoretical to me still. We've had this intentional alpha case study for almost a year now, and we've been implementing this obviously with various PMs in the marketplace, and kind of curious to know, what you've seen and what we've learned and how to make this truly practical. Right.
Yeah, I think one of the interesting things about alpha theory over the years is it generally outperforms our managers. So like I said, it's 4% of additional return per year. But that return stream or that portfolio can be quite a bit different from the portfolio that the manager actually has. So it's telling them to upsize names. It tells them to trade around names. It could end up having some different net exposures. And so what's really cool about the risk-adjusted optimal that we make in combination with a mega point is that it can then be a portfolio that is highly correlated with your existing portfolio. So it's not where alpha theory can be a big leap for a manager. Alpha theory plus a mega point is a smaller leap. And because the portfolio correlation of returns is very high, but you're extracting more alpha, that's where it all comes from. It comes from more of your stock selection return. And while minimizing systematic risk. And, we've seen, we're not doubling Sharpe I wish we could. That would be awesome. But we're getting 10, 20, 30% pickup in Sharpe.
Yeah.
And that's what it's all about. That may be the difference between an LP saying yes and an LP saying no.
Mm-hmm. Yeah, and to say 10 to, when you got a pickup of 10 to 20% in Sharpe at the same risk level, it means you're actually getting 10 to 20% excess return, right?
Yeah.
So that's
it's all coming from IDEO or alpha. Yeah.
Coming from alpha. And as a PM, we kind of bring them to the idea of like, what do I do? I go to some kind of a system where I see, a bunch of information about where my current positions are, where I, need to be. Maybe you can walk kind of our audience through a little bit of how they use this, either I would say daily, but certainly, I'm sure if there's an IC meeting once a week, right, where you're trying to basically assess where you should move things, where the convictions are moving up and down. How would PMs sort of use this information, and what information do they typically see we found to be helpful to them on a practical basis?
Once again, these are fundamental bottoms-up stock pickers. So there's going to be outputs of the research process that alpha theory is capturing. What are some of those outputs that we're typically looking for? It's going to be a price target of where they believe the stock is going to go. Most of our clients don't have a single price target. They generally have bull, base, bear scenarios of where they believe the stock is going to go. That is the primary driver. Then we have a concept called confidence checklist. And what that confidence checklist helps the firm pull out of their research process those attributes that are most important to them that are difficult to capture in a price target. It could be like, how good is the management team? That's kind of difficult to capture in a price target, but it influences how you size the position. Or how good is the balance sheet? Or are there industry tailwinds or industry headwinds? Is there a short-term catalyst? Something subjective like, what's my conviction level? Then that's also fine. These things then lead up to a confidence score. So now imagine we have an expected return and a confidence score. Higher expected return, higher confidence, bigger position, lower expected return, lower confidence, smaller position. These are all outputs coming out of your research process that define the expected return and the confidence. And so we then come up with a suggested position size that is completely intuitive to the fund. So imagine now we have an array of suggested position sizes based on your research coming out of those expected returns and confidences. We then pass that to Omega Point, and back comes this risk-adjusted portfolio. They get to see their actual portfolio, the alpha theory generated portfolio, and we call it RAOP, risk-adjusted optimal position. There's a third column where they can see where the differences are and that final output. And so when they're sitting down, clearly this is daily, they're getting this. And so they can see where the big differences are. But to your point about what the cadence looks like, is certainly one of these things where you have a weekly, bi-weekly meeting where you're reviewing the portfolio, you're looking for the big discrepancies between what your portfolio actually looks like and what that risk-adjusted optimal portfolio suggests you could be. And so when you see big deviations, what's cool is you can see, is it because of the alpha theory bit, where it's based on my research? And if that's kind of in line with where you are, and then the risk-adjusted optimal, you can say, hey, it's the risk portion that's bringing this position size down or bringing it up. And then we have decomposition, which allows you to see a little bit more about where the big loadings are for the security. So you can see, it's telling me to bring this down because it's a big volatility factor load.
Yeah, no, that's important. I think the key is, as we found, start with making it as simple as possible to understand, comparison, and there's always more detail you can get into in the background. But ultimately,
I think a big part of it is you have to be able to, it can't be a black box. There's going to be some black box element. There always is going to be a little bit of that. But if you can make it as intuitive as possible, where you can understand where the piece, then you can have a conversation about it. Once you can have a conversation about it, you can make a conscious, logical decision. Do I want to follow this, or is this going to be an exception I'm going to make?
Right. Yeah. No, very helpful. I think this was a lot of ground that we covered in a short period of time, but this was amazing. I think hopefully everyone understands the benefit of why it makes sense to combine your fundamental views with an understanding of the correlations and the risks, but in an easy to use way that makes it actionable for you to do something with it. Cameron, it's always a pleasure to connect and to talk to you. And you've got great analogies and great ideas, and it makes it easy for everyone else to understand. And I look forward to speaking with you again soon.
Omer, I feel the same way about you. Like I said, I have learned so much from our partnership over the years, and I feel lucky that we are partnered together.